Hello and good morning, everyone, and welcome to the latest in the Novia Global Pulse webinar series. My name is Paul Foreman, International Sales Manager, and delighted to say that we're joined today by Suresh Mistry from Alquity Group. Today, we're going to be taking a close look at sustainable investments, and certainly this is an area which I'm sure all of you have had increased client engagement over the last few years. And indeed, we're now seeing regulatory issues in terms of advisors having to address this area with clients. So with us today, Suresh is going to go through not only the opportunities, but the potential minefields to avoid in this topic. So it'll be about 30 minutes today. As usual, there's an opportunity to ask questions, which we'll cover off at the end using the chat function at the bottom of your screen. Without any further ado, I'll hand you over to Suresh. Thank you.
Thank you very much, Paul, and good morning, everyone. So today's presentation is titled From Boom to Bust and Back Again. So we're going to look at the kind of journey of sustainable investing since its real kind of move into prominence back in the kind of late teens of this, in the kind of 5-8 years ago or so. Before I start, I just want to, if my computer will allow me, to click forward. Oops, there we go. Hopefully you can see my disclaimer. Just meeting our compliance requirements. The presentation today is strictly for professional investors only, but I'm sure you're comfortable with that. In terms of myself, my role is head of sustainability at the Alquity Group. I was one of the co-founders of the original Alquity investment management business back in 2010. And in terms of my day-to-day role within the business, I'm focused around our actual internal responsible investment process, working with the investment team, just looking at the specifics of how we implement some of the responsible and sustainable practices within our investments. I also manage and work with our team to develop the responsible MPS, which we'll talk about today, and the concept of that and how I feel that is quite a unique solution to some of the challenges advisors face today. I'm also responsible for regulatory reporting. Reporting has become a big burden in sustainability. I'm sure you're familiar with that. I also focus a lot on thought leadership, writing on the subject, speaking on the subject, and specifically to the Alquity Group, I'm the lead for our Transforming Lives Foundation. So Alquity itself, we have a unique business model where 10% of our revenues, that's not any of the returns our clients make from our funds, are donated to projects helping some of the most disadvantaged people on the planet. So this is a key part of the Alquity approach to business. So that kind of covers the introduction. In terms of today, I'm going to cover kind of 4 areas. The first is really just talk you through what's happened over the last 10 years, the boom and the bust of sustainable investing, and what that means for you as advisors, because clearly that's going to have an impact on attitudes and what your clients are saying to you. Then I'm going to talk about what I see as the future. And where I see sustainable investing going, and you won't be surprised to learn that I see it actually coming back strongly. And I think there's a lot of evidence to support that. The third element, and this is going to be something that I hope you'll find really interesting and something you can take away and practically implement straight away, is what I believe is the fatal error advisors make when advising clients on sustainable investing. And now if you can avoid that error and you can go down a different route, it's a subtle change, I believe that you will be able to provide your clients with not just the products they need, but an exceptional quality of service. Whatever your view on sustainable investing is, as in terms of your personal perspective, whether you're an advocate or not, the key here is providing clients with the service that you wish, with a high quality service that you would wish to provide them. And finally, I'll show you how we have developed that into our final solution, the bespoke solution that we've developed here, and the Alquity MPS. So without further ado, let's talk about the boom. Since about 2018, I think ESG, for many of us who've been around since 2010, we've kind of been through a lot of periods when when sustainability or ESG or whatever the term was, nobody'd actually heard of. But from about 2018, it just went on a huge rocket in terms of growth. We're seeing 40 or 44% annual growth rate, and this is just ESG assets, so funds with the term ESG used in the title. So we saw rapid growth. Now, to try and explain that rapid growth, I don't think you can pinpoint it down to one particular factor. And so what I decided to do today was dust down one of my old geography textbooks and bring out the famous pest analysis. So I'm sure some of you will be familiar with this. A look at the kind of broad range of kind of political, economic, social and technological factors that really kind of sum up where the movement in terms of sustainability had got to. Now, in terms of politics, the pivotal moment for this kind of move into sustainability was the Paris Agreement in 2015. The COP in Paris agreed this target of 1.5 degree limit on global warming. That triggered a whole host of activities. Governments started putting in place incentives. I mean, I personally benefited from the electric car incentive, for example. But we started seeing sustainability come into the fore. Regulators started putting in place regulation that was there to kind of actually push people towards this space. The EU taxonomy was very much about identifying the areas of the economy in which the EU wanted people to drive assets. On the economic front, we had a very low interest rate environment. People were looking for yield and looking for opportunities to get a return. So moving into new areas such as sustainability supported that. We saw costs of renewables reduce. We saw this idea that climate risk equal financial risk taking hold. So people started moving their money to manage that potential risk from climate change. At the same time, from a social perspective, companies started producing more ESG reports, so they became accountable for their behaviors. Those bad behaving companies got kind of called out at this time. The consumers were making a choice. They were choosing greener or more sustainable brands in preference to maybe traditional brands. And to really kind of, the moment that really kind of highlighted this was the COVID-19 pandemic in 2020. We saw economies shut down. We saw people retrench back into their homes and actually reassess their view on the world, whether that be the environment or whether that be healthcare or their own personal perspectives. But that we saw that as a strong change in social attitudes. And at the same time, technology was moving along at a rapid pace. Data and analytics were being easier to assess. Renewable tech was getting better. And I think the big area was the digital platforms. We saw growth in social media, but we also saw the growth in direct-to-consumer investment platforms, actually enabling investors to directly pick stocks, or not just stocks, but funds themselves. So driven by this broad range of factors, we had this rapid growth through till about the end of 2022. Then there was a rapid and very instantaneous pivot. And you can call this a bust. I've used the word bust here because it does reflect the fact that the attitudes in society and generally to sustainable investing changed dramatically. But the pivot for that was the Russia-Ukraine invasion. That led to increased energy prices increasing, inflation moving up, and a change in all sorts of the economic system, which led people to move away from growth into kind of value investing, particularly from an investment perspective. So as you see here, we saw a decline in ESG funds. So from a period of rapid growth, we're now seeing it flatline and reduce. Not significant in actual amounts of the total ESG assets out there, but we saw a retrenchment. At the same time, with legislation coming in place, SFDR, etc., fund managers stopped producing ESG funds or reduced the new launches. We saw a decline in the number of new ESG or sustainable funds. Now, similarly, from a pest perspective, from a political, economic and social perspective, what happened in the kind of end of 2022 through 23, and we're in the middle of it today now in 2024-25, is we saw a variety of things. Firstly, a regulatory backlash. We've seen regulators want to stamp down on greenwashing, making sure consumers are able to buy products, assuredly. The Russian-Ukraine war, which I've mentioned, and particularly in the US, but increasingly so in other parts of the world, anti-ESG sentiment. Legal challenges in the US to companies in terms of where they were using ESG and whether that was in terms of legally their fiduciary duty. Economically, as we came out of the pandemic and we saw the energy price surge, inflation, interest rates hike, and as a consequence, growth areas of the investment world took a hit. And let's face it, sustainability and sustainable companies tend to be in that growth space. And so those funds took a hit. At the same time, there was also significant performance concerns about sustainable funds. Many of you will have seen that in terms of some of the investments made during that time. I'm going to refer back to this in a second because I think it can be partly explained by some of the economic effects, but there's also another factor that I think drove that. From a social perspective, ESG fatigue, skepticism, people getting fed up with people talking about things, but them not really being able to see the real effects of it. We saw a shift after the pandemic into other priorities. Countries wanted to grow their economies again. People wanted to shift people back into work, etc. So we saw that kind of pivot away from what happened during the pandemic. And the rise of what I would term here anti-woke movements. Essentially what I mean here is that typical liberal views were seen as woke, whether that be on sustainability or in other areas. And they became a challenge for many kind of populist politicians, etc. At the same time, from a technological perspective, you can't go to a presentation today without hearing about AI, and AI took over the kind of focus. And so growth in terms of climate tech development and deployment slowed down. So we've had this perfect storm. And in terms of that performance area, yes, you can talk about the economical change that led to growth not being an area of focus. But also during that boom period, one of the things I observed was a lot of funds were being created and marketed to investors run by sustainability experts. They talked about their knowledge of climate change or biodiversity or, the kind of UN SDGs, for example, and which were great and people really bought into the story. However, they were sustainability experts first, investors second. And I'll give you a classic example. Many people talk about ESG, and I'll explain ESG investing in a second, as a risk tool. And lots of funds talks about, our risks are managed because we do ESG analysis. Now, ESG analysis, from our experience, is a great risk tool at a stock level. So when you're investing in a particular company, doing ESG analysis gives you a great understanding of the risks and opportunities in that stock. ESG analysis does not help you at a portfolio level. And one of the reasons a lot of these funds suffered from significant underperformance was because they had high concentrations. They had not really looked at the portfolio risk, and so were prone to high interest rates, high energy prices, and as a consequence led to underperformance. So this is one of the areas I'd just like to pick out, and I think this is where we're going to see the survival of the fittest in sustainability, because those guys who are investors as well as sustainability experts will be the ones who survive. Now, I said to you, in this title that this is a storm, but it will pass. And let me explain why I think it will pass. A great quote I heard the other day was, the S in ESG now stands for silence. And the facts speak for themselves. In 2023, 40% of S&P 100 companies had ESG in their annual report titles. Today it's 6, and I believe it's even lower than that. So people are not talking about ESG anymore, it's particularly in the US, because clearly there's a legal risk to them talking about it. However, if you dig under the surface, what you find is that now this is the S&P 500, the broader range of companies, the number of companies who see climate change is a risk to their business has grown from 67 to 84%. So companies are increasingly seeing climate change as a risk, but they're not talking about it. And if you see here in 2025, 87% have climate-related targets. So companies are doing climate-associated things, sustainability-driven activities. They've just stopped talking about it. And I think those are where the opportunities are. Finding those companies who are managing that transition. They may not be shouting about it, but through your analysis, understanding the leaders in this space is where we will see growth and success in the future. Now, in terms of that future, let me just kind of give you an idea of a vision I have of where I think sustainability will go. But before I do that, let me just give you a quick explanation of the difference between ESG investing and impact investing. ESG investing, and the reason I'm doing this is one of my biggest frustrations is everybody kind of merges the two into one. And the reality is they're completely different. ESG is an analytical framework that's used by investors such as my team, investment team at Alquity, to assess non-financial factors in an investment. This enables us to identify risks and opportunities other than what we might find in the balance sheet or in the profit and loss account. Now, impact investing is completely different. Impact investing is a conscious decision to invest in target themes and sectors that can have an impact. It could be on the environment, it could be on society, but it's about having a specific focus on a sector. Now, impact investing does not by default incorporate ESG investing. Interesting. Impact investors can invest without doing any ESG, and many of them do. Let me give you a typical example. In many impact fund climate change funds, you will find, say, Tesla as a stock. Now, Tesla will not pass any decent ESG scrutiny at all. So you can see that you won't find Tesla in a good ESG fund, but you may find it in an impact fund. So that is the difference. Now, in terms of the future, what do I see sustainable investing and incorporating both ESG and impact investing moving to, is I see it moving to something I call rational sustainability. This is a move away from this kind of theatre, this marketing-led approach that we've seen a lot over the last few years. What rational sustainability is just common sense. It's just saying, actually, when I look at these things like sustainability, when I look at impact, I'm going to look at those factors alongside financial goals. I'm going to make sure my investment decisions are based on the hard evidence. Now, I might have ideological views, I might have a perspective on things, but if I can't prove it and I can't show the outcomes, they're just good intentions. So when I'm investing on behalf of my clients, I need to be completely rational. And now what that means is that there's a big difference in moving, and I think the future of sustainability is going to be driven by funds and companies that are focusing on real world change, not just tick boxing. Deeply integrating sustainability analysis into their investment decision making, not just getting ratings from another agency or from elsewhere. They're focusing on evidence, not ideology. It's not about doing more. I went through a period of over the last few years, it felt like the regulator just kept wanting you to do more and more and more and more, when actually, was that actually adding any value? This is about actually being really kind of tight on your activity to make sure you're doing better, not just doing more. You still retain your values. This is not about changing values. This is not about changing your views. It's about putting them into practice through a practical framework. And as I mentioned earlier, this is not about just looking at stocks. This is about portfolios. We're as sustainable investors now. We're not sustainability experts alone. What's that look like in terms of reality? Let me give you a couple of examples to kind of bring sustainability to life. A great example of a stock, Schneider Electric, you will find both in traditional portfolios as well in sustainable portfolios. Schneider Electric is a large French industrial business that produces and works with companies to, build buildings, put in place escalators, lifts, all the kind of electrification. Some time ago, ahead of their peers, Schneider moved into energy efficiency, helping their clients reduce their carbon emissions, reduce their environmental impact in their products, in the way their products were designed. That has led to significant price growth, and even in just the last year, protected price growth, the share price growth of 18%. It's a positive example. You compare that to some of its key peers, Alstom, people like that, they've well outperformed. Now, I'll give you a negative story in terms of sustainability, and this one I'm sure will be familiar with many of you. Greggs, the bakers. If you're not from the UK, Greggs is a huge chain of bakeries run around the UK. They're famous for their sausage rolls and have grown rapidly over the last few years. But in the summer of 2025, they actually issued a profits warning because that previous 6 months, in the January, their supply chain and their stores were massively hit by storms. And then in June, we had in the UK some real strong heat waves. And as a consequence, people did not want to eat sausage rolls. And now their cold drink sales grew, but their main product, their main profit stopped hugely. And so it directly affected their profitability. And so you can see now how climate-related disruptions have environmental risks on operations, on profitability. And this is why companies, even such as Greggs, will need to bake in, literally, excuse the pun there, bake in sustainability into their future plans. Okay, so that kind of captures the world of sustainable investing, the boom, the bust, and why I think there is a hope for the future. Now, bringing it back to advisors and yourselves and the role you perform in terms of advising clients. We've worked extensively with advisor groups, and this is something that has come out from some of that work. Now, let me give you an example here. Let's imagine you've got 3 clients. And you want to advise them on their sustainable investing preferences. On the left, you have Greta. Now, Greta, young, dynamic individual, hugely concerned about climate change, hugely concerned about the impact of global warming, and your KYC analysis shows that that's her big focus and intention. You also have a client called David. Now, David's a senior gentleman, has spent his career involved in nature, very concerned about the natural world, the forests, the trees, the seas, and our natural wildlife. Hugely concerned about the future and the extinction of many species. And then we have Bob. Now, Bob, long career in pop, in music, but very concerned about inequality. The great disparity between what we have in developed nations versus the developing world, and the issues in the developing world such as famine and access to capital, and the kind of steel ceiling that's held over many of the people in this part of the world. 3 clients, all assessed. Now, the question and the fatal error most advisors make is when looking at these 3, they ask themselves the following question: how green are each of them? How green is Greta? How green is David? Is he a mid-green, light green, dark green? And is Bob greener than David, or David greener than Greta? It's a completely false question, because you might as well just put them in order of height for the difference it makes, because the assessment of how green somebody is entirely subjective. It's the filter that you would use, the values you place on greenness. And I've seen many tools where the number of boxes that the clients ticked gives people a score of their level of greenness. It's a complete interpretation, when in reality, why don't we move away from asking the question how green each of them are, to actually saying, well, Greta, you're worried about global warming, catastrophic climate change. Well, let me give you a solution that's focused on climate change. There's no interpretation. There's no subjectivity. It's purely objective. You've stated this. I'm actually going to give you a solution that solves and meets your preferences. From David's perspective, he's worried about the loss of nature and the extinction of wild species. Well, David, I've got a project here that's nature and biodiversity protection. This fits in with your preference. I'm not making a judgment on how green you are. I'm not making a judgment on your views on the sustainability. I'm just responding to your specific request. And finally, Bob, inequality in society and eradicating poverty. Well, Bob, we have a social justice solution that fits in with your requirements. Now, of course, many clients will be a mixture of these. I've used Greta, Bob, and David as kind of to bring out the story here. Now, you will have a blend, but you may also have clients with a significant focus on one of these three areas. And so when you're presenting the solution, avoiding any subjectivity, avoiding any kind of discussion about greenness, what you say is actually based on your responses, I believe a solution focused on climate change would meet your needs. And so what we've done at Alquity is develop that. We've developed a set of portfolios that are tailored to individual client suitability sustainability preferences. We focus on three areas, the ones I've mentioned: climate change, nature and biodiversity, and social justice. And then we have a blend, because clearly some clients will be a mixture of those. What that means is you can offer clients a solution to their specific preferences. Clients can also choose their level of sustainable exposure. We're not saying to clients you have to put 100%, because clearly, as we've shown earlier, impact investing has risk inherent in it. And we've managed that risk, but we've got to realize that you as advisors need to provide your clients with suitable recommendations based upon their current situation. We need to deliver that impact, but we need to deliver it with returns, because that's our goal. Remember, we're investing. Rational sustainability sits at the heart of this. When we're assessing the funds and the portfolios, we need to make sure it's based on science, based on risk management, based on long-term profitability and returns in the portfolio. And what we've done is, for these portfolios, we've built a clear structure. Let me just explain that structure to you. We have what we call a sustainable core. Now, what sits in there is these high quality ESG strategies, the ones I talked to you about earlier, where we're using ESG analysis to really identify opportunities and risks in companies and put together great strategies. These could be both equity and bonds that enable us to create a ballast in the portfolio, which enable us then to give the tilt, the impact tilt, whether that be climate change, social justice, or nature and biodiversity. Meeting your client's requirement, but doing it in a risk managed way, and ensuring that that portfolio that we present has diversification to offset that focus that the impact tilts provide. We produced these for a client over a year ago, and over the last 12 months, this is just the kind of an overview of performance. We use the ARC equity risk profile for comparison, and you'll notice the responsible portfolios are adventurous in growth. As I mentioned earlier, we tend to be on the higher end of the risk spectrum with sustainability. It's only 11 months, okay? So that's the caveat here, as the disclaimer at the bottom says. But where we're comfortable is that we're seeing consistent performance. We're seeing that nice blend between the sustainable core and the impact tilt, helping us achieve both the impact that clients are and the reporting. We can provide detailed reporting on the impact, but also the returns. And this is something we think we will build over time, and enables you to confidently present to clients solutions that meet both their investment preferences in terms of sustainability, but also their returns objectives. So when implementing this within organizations, now this is really targeting for any guys on the call right now who run businesses, who have several advisors in their organizations. You can't just provide a solution such as these MPSs and expect advisors to go and deliver them. You have to train, because This is about building an ecosystem around your advisors to ensure that they can provide you and your clients the quality and the regulatory standards in terms of advice. So we train in how to acknowledge client concerns about sustainable investing. If people are really concerned about the geopolitical environment, what Trump will say tomorrow, or what will happen in terms of the UK, we can help in terms of acknowledging those concerns and also how to respond to them whilst remaining neutral and objective. It's very difficult sometimes to stay neutral and objective because then there's a natural tendency for perspectives to come out. We'll also talk about how you educate clients on the risks and opportunities of sustainable investing. It's very easy sometimes to talk about just the risks, but there are some significant opportunities here as well, and we shouldn't be deterring clients away from this area without actually giving them the full information. Using examples like Greg's and other companies, we can really communicate that real world significance. Make it real for clients. This is what's happening. This is the reality of our environment. And if we can do that, we can then help empower clients to actually come up with a solution that fits their needs and is actually tailored to them. And so we provide a whole suite of tools, documents, training that can enable our clients to actually influence the responsible MPS through their businesses. So that really captures the key aspects of my presentation today. The real focus on the boom and the bust, why I think there will be a boom again, what is rational sustainability in the future, sustainable investing, and what is that fatal error that advisors can make that if we can avoid, we can actually provide an exceptional level of service to our clients. Now, from an Alquity perspective, remember at the beginning I mentioned the Transforming Lives Foundation? Well, some of the portfolios do actually hold Alquity funds. Clearly, we are an ESG investor and a sustainability-driven organization. And one of our commitments is that the revenues from the funds, the funds we have, 10% is donated directly to projects where we invest. So you will be able to, what we'll be able to do is as your clients invest, we'll be able to report back to you on projects, on lives transformed. So kind of that social justice aspect, which is a key part of the Alquity business model. And I think I see that as a cherry on the cake. I think really the cake is the portfolios and the ability we can provide you and the support we can provide you to actually support your clients directly. If you'd like more information on anything I've talked about today, please do feel free to reach out and contact me. And I think that kind of covers what I wanted to say for today. And I think we can now hand over to some questions. I'll stop the share, Paul, and then hand over to you to help us with questions.
Thank you very much, Suresh. Real great insight there into what can be a complex area of financial planning, and certainly some great practical hints and tips that the advisors on the call today can take away with them. But firstly, I must just say congratulations. You are the only presenter this year to have got sausage rolls into the presentation. So you win the award for that one, most definitely. And glad to say we do have some questions from the floor. So I'll jump straight in with them. So thanks for the presentation, Suresh. Given how varied clients' definitions of sustainable investing can be, what practical steps would you recommend I can take to better understand and also document what sustainability means to them personally?
Yeah, there is a whole range. What steps can you take to understand? I think what I would suggest doing in this case and communicating it to clients is understanding that sustainable investing is just like any other type of investing. It has, just as you would look at some, global equity strategies, or just as you look at investing in AI, treat all the different aspects of sustainable investing as just different forms of addressing that asset class. So if it's impact, as I've said earlier, explain to clients clearly that impact investing is a sector. It's what do we call the phrase has just jumped out of my mind. It's a sector-specific investment. You are ignoring large parts of the market. You're saying, I just want to do that piece. So if it's akin to AI investing, for example. If you're just focused on AI, you're focused on companies that are going to benefit from the use of AI, and a fund that just does AI is only going to invest in that. Now, if AI goes up, great. If AI goes down, that fund cannot change its mandate. It's still going to be AI focused, just like an impact fund. If it's climate change or social impact, it can't all of a sudden turn from climate change to nature and biodiversity because that market's dropped. So it's about explaining the different areas. ESG investing, as I've explained, please do separate out ESG investing from impact investing. Make that absolutely clear. So the slide that I've just shared, ESG and impact investing, I think that's the crux. If clients understand that there are funds out there that just use this tool to make better investment decisions, great. If I want to deliver direct impact, then there are funds out there that pick certain sectors. They may or may not use ESG, but if they don't, I still get that impact. If they do, I still get that impact. And if I don't, when I'm investing in ESG funds, don't expect impact. Okay, a cigarette company, a tobacco company has an ESG score, and so does every business on the planet. Hopefully that helps, but it's about understanding the different aspects.
Another question is, from my experience, some clients are feeling fatigued or skeptical after the volatility of the past couple of years. How can I look to rebuild confidence in sustainable investing with my clients without over-promising to them?
Yeah, this is back to being really truly objective and explaining the scenario. I've explained, I think I've tried to show you today the drivers and the factors of response of all investing, or politically, the environment that we're in. I think as an advisor, don't get into opinions about things. Stay entirely neutral and objective. This is the world we live in today. We have an environment today where politically certain views are stronger than others. That may change, that may continue. We have an economic environment where we're seeing interest rates reduce. We're seeing that in the US, we saw that yesterday, we're seeing that in the UK. That is conducive to growth. Sustainable investing is, by definition, it's often newer and younger companies that are growing. So growth will become, but there may be a point where that pivots. Okay, so remaining objective, actually explaining to your clients what sustainable investing is, the point I made earlier about ESG and impact. So if I'm trying to give my clients confidence in sustainability, I think I would explain the scenario, the situation objectively. I would explain to them the different types of sustainable investing that are out there. And this point I made at the end about rational sustainability, that actually this is a sector of the market that has matured, and as in any kind of growing sector, there's going to be fallout and there's going to be the survival of the fittest. And what you can now see are funds and investors who really know what they're doing in this space. And so look for, as you would with any fund, look for strong track records, look for great investment processes, judge companies on what they do, not just what they say. So building those elements into your communication with your clients will really help, I think, build the confidence. And finally, and just to throw it in there, you don't have to put 100% of the client's money into responsible investments, right? This is not a zero sum. You can't. If a client really wants to invest, but you understand, the risk levels and their exposure, you want to manage that. Well, manage that over time. Maybe 20%, 30% builds over time to actually build that confidence.
Thank you. And another one here. What is the one sustainability metric that you think advisors should prioritize above all others, if there is one?
Whew, that's $1 million question. What sustainability metric would I suggest advisors focus on? I definitely don't focus on greenhouse gas emissions intensity from your portfolio. I can tell you what one I wouldn't focus on is that, because that's absolutely meaningless. because you can reduce the greenhouse gas emissions in a fund by just stop investing in a manufacturing company and invest in a tech company. That would reduce your greenhouse gas emissions. So definitely not that. I would. That's a really good question. What would be the metric I would focus on? You know what? I think what I would focus on is how many companies. Almost. It's not even a sustainability metric. It's more a metric of the quality of the investment process. It's what they don't invest in. It's the companies that they are excluding from their portfolio. Gives you much more confidence about what they're doing, about their process. So I'd be looking at more metrics about the companies within their portfolio, and understanding what they're not picking as much as what they are picking. But a single sustainability metric, it's a difficult one to predict. I will have a good think about that, and I will come back to you. But once I've had a chance to think, it's a question I've never had before.
Yeah, on the spot there, Suresh. And we're looking here at a couple of comments regarding the donation you covered off towards the end. So one just saying very admirable with your donation to support life-changing projects. And one other attendee said, sorry, the sound went at the end. Could you explain the 10% donation to the projects again, please?
Yeah, no problem. So obviously we run funds and charge a fee for those funds. The revenue we make, not the returns on the funds, it's from the fees. We donate 10%. So every month, 10% is extracted from our P&L and passed to the Transforming Lives Foundation, which is a separate foundation run by an independent group of trustees. And the foundation's goal is economic empowerment, is to help people, disadvantaged groups. Alquity's heritage is in emerging markets. And so we've invested in countries like India, Indonesia, Africa, across kind of Latin America. And what we believe is by using this money to directly affect the lives of disadvantaged groups, people who'd be excluded from social development. Remember, many of these economies are growing at a fast rate. And the problem we see is not the growth rate, it's the inequality that growth rate creates. Now, if we can support more equal society, we believe that is sustainable, more sustainable for the economy, and our investments will deliver a better return in that long run because we've built a more fairer and equal society. So the purpose of that 10% is to help those who would otherwise not get the opportunity. So we work with groups that train disadvantaged youths in tech skills, or maybe provide them with in India, we provide rural women with chicken toolkits. Now, crazy as it seems, we provide them a toolkit with 10 chicks, feed, etc. So they can stay at home and they can build a little business that can generate them some income that will send their kids to school. That kid then has an opportunity to get an education. If they can get an education, they can break through some of the social barriers. So it's very much driven by that purpose. In addition, and this is something that's developed over the last few years, which I think is really unique to Alquity, is when I go to India, or our team, investment team, we go and interview the women or the kids, the youths in these projects. And we do consumer panels. So we actually understand what's going on in the economy, because these are the people who are living and breathing the economy. We ask them about brands. We ask them what they do with their mobile phone. How do data costs impact on the way they lead their lives? That informs our investment process. And, we have examples of stocks that have entered into our portfolio because of the research we've been able to do to a much deeper level than any of our competitors, because we have these relationships on the ground in many of these countries.
And just as a final word, I know we briefly touched on it in the introduction there, but there's not much these days that falls outside the scope of the regulators. With that in mind, are there any things you think advisors should be aware in terms of regulation and this particular topic?
Yes. Clearly, we've seen in the UK at the fund level, we've seen the implementation of SDR, which is around the fund labeling, which was meant to make things a lot easier. Unfortunately, I think at last count there was about 100 funds that had actually got a label, which is nowhere near enough. I think there was something like I was at a presentation where there's 100 funds with a label, and there's 434 that are sustainable but unlabeled. Don't ask me what that means, but basically, I think most fund managers are just waiting for the legislation to kind of make sense. And as a consequence, you can't build a portfolio when you've only got a total of 100 funds out there. That it's just not going to give you the diversification and opportunities. So that's a challenge. But I can see that changing quite quickly with the FCA making a lot of moves in terms of that. SFDR is changing. So many of you in Europe will be familiar with Article 8, Article 9 funds. That's due to change, not for another year or so at least. But that's going to move to a bit more of a labeling regime like the UK. So funds will be labeled by what they try and do, whether it's impact or whether it's kind of trying to reduce, ESG or whatever. So we're going to see a bit of a move in that area. For advisors, I think you're going to see more legislation around your responding to client specific preferences, which is where this project came from, where this solution came from. Because if you think about it from an audit perspective, your client said, climate change or social impact is what I care about. You've provided them the exact response to that requirement, and whether they go with that solution or go with the blend or another option, you can show an audit that you have actually responded to the client's request, which I think is where the sustainability and the regulator is going to go. In fact, I think the FCA in the beginning of January, are producing a white paper on this for advisors called from the Advisors Sustainability Group. So as soon as that come out, maybe I'll do another webinar and talk you through that.
Excellent. Well, that's it for the questions. So you can now relax a bit, Suresh. Thank you very much for your input today. And obviously, the Alquity solutions are available on the platform. So if you do have any questions, please approach your usual sales contact at Novia Global. As always, we will make a recording available for you in the next 48 hours, and feel free to share that with any colleagues who couldn't make it today. This is the last webinar of the year, so we will be back in the new year in January, and there will be a newsletter coming in the next few days as well from us. So once again, thanks to Suresh for your input today, and hopefully not too soon, but just like to wish everybody and their families a very Merry Christmas and a happy, healthy and prosperous new year. Thank you very much. Goodbye.
Thanks everyone. Goodbye. Take care.